Just Botillier here, CEO of Calyx CPA. So today what I'd like to do is talk to you about 280E, where we were 10 years ago, say, and where we are now. As you may know, we've been talking a lot about amending tax returns for refunds. We've been talking about moving forward without reducing deductions because of 280E. In the wake of what's happening with TrueLeave and these other MSOs that are also refusing to pay tax on 280E and have been successful at amending their tax returns for refunds. But I think it's important to understand before amending your returns, a little bit about the history of 280E, how accountants in this industry have attempted to mitigate the fallout of 280E, and then what kind of justification or reasonable basis that we're using now to amend tax returns for refunds, and where we see what kind of impact we see rescheduling having on the cannabis industry, and what we think the IRS's response will be to that. So I'll try to keep it brief because I don't want to bore you, but I'll talk to you a little bit about a little bit of my experience with it and how it impacted the cannabis industry back when the first dispensaries, say, were rolling out in the medical programs to where we are now. So as you may know, we're based in Southern Oregon. We have a very large outdoor grower population here. We're kind of part of this Emerald Triangle, not necessarily officially. That's like a very California thing, but I would say that the microclimate of Southern Oregon and Northern California is very similar. And we're able to produce high quality sun-grown cannabis at low prices here in Southern Oregon. And so in the early days of the medical program, I started to get a lot of clients that were knocking on my door that needed help with their taxes, but they wanted to keep it on the down low. And at that time, this was maybe 2014, 2013, something like that. At that time, I was like, okay, I don't know what you're doing, right? We'll go ahead and file your returns. And they're like saying, well, they're campgrounds and they're nurseries and those kinds of things. And I didn't know for sure that they were in cannabis, right? So we weren't taking into consideration 280E. And fortunately, 280E does not affect cultivation like it affects dispensaries. But to the run-up of the recreational market or recreation licenses passing in 2016, people started to Facebook me and Facebook friend me, and then I see their cannabis farms in the background in their photos, and I'm like, hey, obviously you're running a marijuana grow operation here. Now we really have to make sure that we are following 280E to the letter of the law, right? We really need to get focused on this and how it's going to impact. And fortunately for cultivation, it didn't have much of an impact because most everything, especially in the medical days, was for what money was spent on the cultivation and a lot less on like advertising, professional fees, and more like overheadsy stuff. It was all deductible as cost of goods sold. So their 280E impact was not as great. But in 2014, dispensaries started to roll in onto the medical dispensaries started to roll onto the Oregon market. And this is very much the early days, I think, just right behind Colorado. And it was very clear that when we applied 280E to these businesses, they were getting hammered, 80 to 90% effective tax rates, absolutely unsustainable, miring them in tax debt right out of the gate. Before I even filed a single one of those, before we sent a single one of those to the IRS, I couldn't believe it. And so I went to work trying to figure out, like, what are the strategies to mitigate this, because this is completely unreasonable. They will go bankrupt immediately if we mire them in this kind of tax debt. So I did go to Colorado, And I went for some continuing education thinking, okay, these guys from Washington, California, Colorado, we're gonna meet up in Colorado. And at that time, we were the only ones with the rec programs, or at least the ones that were showing up. And I thought, okay, these guys certainly know a way to mitigate the impact of 280E. Not at all. They had no idea. It was just, this is 280E, your clients are screwed. That is what that they taught us at that continuing education. Well, that wrapped up very quickly. We all kind of did a round robin, and we were all the students in that room got together and like, what are you doing? What are you doing? What are you doing? And we landed on a few things. We landed on 263A, which is an IRS code section that was essentially guiding a taxpayer, specifically a manufacturer, on how they should be calculating their inventory. Now, we were thinking, okay, well, we can certainly justify moving some overhead into inventory and therefore deduct it as cost of goods sold, because that's actually what you do with inventory when you write it down is you include it into cost of goods sold, and that's how we are able to justify moving some overhead into cost of goods sold. We move it into inventory and then we move it into cost of goods sold. That's how that works. And so 263A gave us an opportunity to be able to lessen the burden of 280E and move some overhead into inventory and therefore into cost of goods sold, and and help our clients get a little bit more tax deductions. Unfortunately, in 263A, it says very clearly that if these transactions or these expenses are otherwise disallowed due to other tax code sections, i.e. 280E, then you can't use it. You cannot use 263A. When we saw that, or at least somebody at this place brought that up, and we all agreed, okay, well, that means we can't use 263A. Well, what about a code section called 471A? That is very much the same kind of situation. It is guidance on, it was actually imposed by the IRS to force manufacturing companies to move overhead into inventory so that they had to delay their deductions and thus pay more tax in the current year. So the accountants in the cannabis industry, we jumped on that. We're like, absolutely, that's what we're going to do. 471A. We're going to, especially with retail, we're going to allocate some overhead based on square footage. We're going to have the employees clock in and clock out depending on what they're doing. So if, say, they are in the back, when they're in the back, bagging, tagging, processing, doing added value stuff, maybe like rolling pre-rolls or whatever, then we're going to deduct that payroll. But then when they're out on the sales floor, we're going to disallow that payroll, okay? And then we would do kind of a square footage map, and we would be like, okay, when 30% of the total square footage of this facility is dedicated to value-added processing and inventory storage, we're going to deduct 30% of rent and utilities and facility costs. Okay, so that is where the industry landed, and that is where most accountants right now who are doing tax returns, that is what they're doing. That's it's kind of under an originally what we would consider a 471A methodology. And even that was hard to defend. And the reason why it's hard to defend is because it doesn't apply to retail. It really only applies to manufacturing, okay? So 471A at that time was our best option to make things reasonable enough for our clients to stay in business, but it wasn't a bulletproof plan. Now, but we continued to do it anyway. And most accountants who did any of their homework was using some sort of methodology like that to advocate for their clients and to make sure they can stay into business. Fast forward to 2018, the Tax Cuts and Jobs Act rolls out. Donald Trump was president. He passes that act. they then implement what's called 471C. 471C was intended to make inventory calculations for all businesses easier. And it was incredibly helpful to the cannabis industry. What it did was it said, like, okay, it doesn't matter if you're a manufacturer or a retail or any business. You can choose how to do your inventory based on your books and records. And that is really what it says. And so the cannabis industry was like, okay, so are you saying we can move whatever we want into inventory and thus deduct it as cost of goods sold? And the answer is yes. According to 471C, you can do that. And so we all like jump for joy. Like, and some people, unfortunately, were like blogging and doing videos and saying, 280E is dead. Like they were yelling it from the rooftops. 280E is dead. And for a couple of years, we had this window where we could be pretty aggressive with deductions by moving overhead into inventory and then deducting as cost of goods sold. So we're talking about payroll, we're talking about facility costs, we're talking about almost everything. I mean, we jumped on it for sure. And we were deducting most of our clients' expenses, but for a couple of categories that were like, that's too overheadsy. We can't defend that narrative. We can't say, hey, we're trying to figure out, we're trying to match our cost of goods sold to our income. And so therefore we're going to include advertising. That, I mean, you could do that. It's absolutely legal, but it's hard to defend that narrative when advertising is such a discretionary spending category. So we would disallow that. We're like, hey, we got to throw the IRS a bone here. We can't be disallowing, we can't be deducting advertising as cost of goods sold. So there was a handful of overhead accounts that we would not allow, but we would then deduct a lot of the payroll and facility costs. And that brought our clients' tax liability down to near levels that were near what they would have to pay if they were a legal business. And it's great. Unfortunately, the IRS got a lot of pressure from a governing body, their governing body. I think it's called TIGTA. I don't know what that stands for exactly, Department of Treasury of some sort. And they forced the IRS to do something about it. You need to close this loophole. And so then what the IRS did was they put out what's called regulation. And they said, and interestingly enough, it was very similar. The wording was very similar to what was in code section 263A. It's pretty much said, hey, if this expense is disallowed by another code section, then you can't use 471C. Okay, you can't put this in inventory. You can't put it in there. And so that was like a huge deterrent for the cannabis industry. So anybody who even thought about like going to 471C saw this regulation put out by the IRS and was like, okay, we can't use 471C. The regulation says we can't use it. But the IRS doesn't write the tax codes. Regulation is an interpretation of the tax code, just like we interpret the tax code. The IRS regulation is to help guide the accountants to understand what the tax code is. But it isn't the tax code. Congress writes the tax code, not the IRS. And Congress wrote in 263A, that one that we don't use, the code section that we don't use, that if an expense is otherwise disallowed by 280E, we can't use 263A. There's nothing like that in 471. There's nothing like that. So what the IRS did was created regulation that has no foundation in tax code. That's me like coming up and saying, the tax code says that any number of fictitious things, like I made it up. Like I am interpreting the code in a way that there's nothing in the code that says this. So the it's not just my interpretation. This is supported by tax attorneys. and by a small segment of accountants who have done their homework and have done their research. The truth of the matter is that this regulation has no teeth, but it did a fantastic job at deterring the accountants from using an aggressive methodology. So what we did was we continued to use 471C just like we had always been using it, but now we had to put in like disclosures saying, hey, we know this regulation exists, but we don't agree with it in much more subtler terms, and we don't want to kick the hornet's nest, but we're moving overhead into inventory just like we always have, but we're going to let you know about it. We're telling you that this is what we're doing because we don't believe that this regulation is sound in terms of its ability to enforce this, or it's an actual interpretation of the code. We think it's more of an opinion or a reaction to this loophole. So we continue to use it. And then we've gotten word back that, okay, over the years, and it's been about 5 years now, we have there have been audits, but those audits have not resulted in an adjustment to those tax returns for companies that use 471C. Our firm has not had to deal with a lot. I mean, though we do hundreds of cannabis tax returns every year, we have never had to dispute this 471C position, even though we put in disclosures and we're telling the IRS that, hey, we're doing this differently. We have not, knock on wood, had to defend our position, even though early on, other accounts I would talk to would be like, how could you do this? You're putting your clients at risk. You're just asking for an audit. It's not if, it's a matter of when. And 5 years later, I'm like, when, okay? So it turns out that there's some literature and some conversations that have happened with the IRS and some other, little hints and clues that have led me to believe that the IRS knows and is choosing not to enforce that regulation. Okay, so that means for over 5 years, accountants could have been using 471C in an aggressive way, but have not because they were afraid of that regulation. They did not do their homework. Okay, and now all of those people who were using accountants and attorneys that were overly conservative essentially screwed their clients over for years. And now 471C, this approach, is actually almost conservative. And anybody who is not using a methodology at this point is doing their clients a very big disservice. They should be at least using some sort of methodology, even if it's an old-fashioned 471A. But even then, that is not advocating for your clients. You can do more for them. Now we are, let's see here. Let's talk about December 2023. Trulieve, large MSO, amends their tax returns 2019, 2020, 2021, 2022, I believe, or maybe it was 2018. I can't remember. Receives $113 million from the IRS because they're saying that they have a reasonable basis to believe that 280E shouldn't have applied to them. Now, they kept it under wraps. They're saying it's proprietary information, their argument, okay, because they're being conservative and cautious because they believe the IRS will eventually audit them, and they're going to need to be able to hold their cards close to hand so that when they have this legal battle, they can play their cards, right? And there is a statute of limitation for how long the IRS can audit a business, okay? It's 3 years. It's the same statute of limitations that a company has for amending their tax returns for a refund. So for example, right now, you can amend your 2020 tax return for a refund up to the date that you filed the tax return to begin with, in 2021, or the filing due date. So like if you filed your tax return in October 15th of 2021 for 2020, you have until October 15th, 2024. Well, guess what? The IRS only has the option to audit you up to October 15th, 2024, unless they deem, there's other caveats. I mean, the statute of limitations rules are a little bit more nuanced than that, but essentially they have a limited amount of time to audit you. And so I think what's probably going to happen is you're going to find that the IRS may stay mum on True Leave and allow the accountants to do their job for them by not doing anything. Most of the accountants will probably not amend their clients' tax returns, will probably not try to make an argument for their clients to not pay tax on 280E. And thus, when eventually 280E goes away and it's a no big deal anymore, all those clients, all those taxpayers will have lost their ability to amend returns and recapture those deductions. So the whole point of this is that it is important that you do act now. It's important that you either attempt to amend your tax return for a refund, or you do what's called a protective claim for refund and keep the statute of limitations open. So one thing I need to back up a little bit, like what kind of justification are we using to do that, right? Like what is True Leave doing? So we've heard from other tax attorneys and people who work for these companies that are refusing to pay tax on 280E or amending for refunds, that they are saying that there's a host of reasons why they believe that 280E should not have been imposed on the cannabis industry. And it's the first one that comes to my mind that's a no-brainer, is that the HSA says that cannabis should be Schedule 3, not Schedule 1. Well, Schedule 1 and Schedule 3 are kind of a statement of fact. They're saying that like by having it in Schedule 1, cannabis is as dangerous as meth, for example, and crack cocaine. And it's highly addictive and very dangerous, and therefore it should be banned and not allowed at the highest level. Well, the HSA, a federal authority, says no. It should be Schedule 3 because we all know it's not dangerous and there was medical programs. So it should have been a Schedule 3 drug way at the beginning, right? But they refused because they were anti-cannabis, just because they were anti-cannabis. It was an ideology, not fact. Okay, so that's like number one. Number two is that the legal landscape has changed tremendously since medical programs were rolling out across the United States. Since it was only Colorado, California, Oregon, Washington, the legal landscape has changed. Now we've got, I think, 40 states with some sort of programs. And for years, cannabis should have been, the states should have been allowed to regulate their own cannabis industries. And in fact, Congress did make moves to kind of demonstrate that, yes, states, we are allowing you to manage your own cannabis programs. The DOJ was like not funding the DEA to enforce the Controlled Substances Act and therefore 280E in the states that had cannabis programs. And so back in 2015, there was a court case that went to the Supreme Court, and ultimately it was lost, and the Supreme Court held the federal government in favor for that, or ruled in favor of the federal government. But it was called Gonzalez versus Reich, and that was it was a cannabis company or group or person, I can't remember who it was exactly, but they were saying, well, this is an entirely intrastate commerce issue. It is a state cannabis or a state regulated cannabis program. We are not allowed to cross state lines, and therefore we shouldn't be. We should not. The Controlled Substances Act should not apply to California, people in California, because it's against the Interstate Commerce Clause. It's unconstitutional. And the Supreme Court at that time was much more liberal. They ruled in the federal government's favor, but Justice Clarence Thomas, who is the conservative holdout at that time, said, hey, I think he dissented and was like, this is unconstitutional. It violates the Interstate Commerce Clause. And so that is one of the big arguments that we believe in the cannabis industry, that if it were argued today, the Supreme Court would have a very much of a different ruling, okay? Because now they are mostly conservative, just like Clarence Thomas. They overruled Roe versus Wade, which means that they really are more constitutionalist. And if this were taken to the Supreme Court, then they would probably say that 280E or the Controlled Substances Acts being imposed on states' cannabis programs is unconstitutional, and therefore 280E does not apply, and it should not have applied for years. So that's the big argument for the reason why we have a reasonable basis to attempt to get refunds and to recapture these lost deductions. And the statute of limitations has not run out for 2020 yet for most people, probably most business owners. And you can amend for 2021, 2022, and consider moving forward without reducing deductions due to 280E. So one of the questions that I get is like, what's the success rate? I don't know. I do know that I have been told that some businesses have been amending and they've been getting refunds. Our company has just started to do amendments. It takes time. But will we ever get the nod from the IRS saying that, yes, you can amend your returns? I don't think so. I think what's going to happen is rescheduling is going to happen. It's going to go from Schedule 1 to Schedule 3. I don't know when it's going to happen. It may happen in 2024. It takes a long time for things to roll and for the DEA to say like, okay, now cannabis is Schedule 3. It's going to take time. So it may be 2025. Now, when that happens, other things will have to happen. And then finally the IRS will say like, okay, 280E doesn't apply. 280E doesn't apply anymore. And it's probably on the date that the DEA rescheduled. At that date, 280E doesn't apply. So if it's in 2025, then we have another year where 280E is taking its toll on the cannabis industry. Will the IRS give you the nod? Will the IRS give you the nod to amend? I think that unless a case is tried and taken to the Supreme Court and the Controlled Substances Act being imposed on states with their own cannabis programs, is litigated and the court rules in the plaintiff's favor, the IRS is not going to allow you to amend your returns. They're not going to say it, okay? But are they going to audit and fast track that court case up to the Supreme Court? Because like certainly if they audit Trulieve has $1 million lawyers that are going to argue the case all the way up to the Supreme Court, and they probably will win. Okay. Does the IRS want you to do that? No. And the reason why is because if Trulieve then wins that case, then the entire cannabis industry has the nod to amend their tax returns, and that's expensive, right? Now the IRS is doling out money. Not that the government doesn't spend money, right? Like, but the IRS doesn't want to give you money. So I think that they're probably going to take a similar approach to what they did with 471C and just say nothing and let the accountants do their job for them. Okay. So I hope that makes sense. The IRS does nothing and the accountants do their job for them. Okay, and I think that that's what's going to happen. They're not going to give the nod to amend your your returns. They're going to wait until the statute of limitations runs out, and even if they say yes, it's okay, it'll be too late for all of you to get your deductions back. If you have any questions, check out my website or our website, www.calyxcpa.com. Reach out. We do a weekly webinar at every Friday at 10 a.m. Email us, we can send you the link if you want to have more of a discussion. But I hope this has been enlightening, and watch it a few times until you get it.